Shall we start? Good afternoon, everyone. Thank you for coming to the first bi-monthly of the new fiscal year. We take this opportunity to welcome Mr. Kanungo to his first post-monetary policy press conference. Let me start with the Monetary Policy Committee's decision today. The MPC made a detailed assessment of macroeconomic and financial conditions, both domestically and globally, on the basis of its judgment on the evolving outlook. And the MPC decided unanimously to keep the policy rate unchanged in this review. The MPC also decided to persevere with a neutral stance of monetary policy. It noted that inflation is set to undershoot the target of 5% for Q4 for 2016-17. For 2017-18, inflation is projected to average 4.5% in the first half of the year and 5% in the second half, with risks balanced around the inflation trajectory. The MPC also noted that GVA growth could strengthen to 7.4% in the current fiscal year from 6.7% in the last fiscal year, with risks balanced. The MPC saw the path of inflation in 2017-18 as challenged by upside risks and unfavorable base effects towards the second half of the year. Accordingly, inflation developments have to be closely and continuously monitored, with food price pressures kept in check so that inflation expectations can be re-anchored. Accordingly, the future course of monetary policy will largely depend on incoming data on how macroeconomic conditions are evolving. The committee took note of the reduction in bank lending rates, but saw further scope for a more complete transmission, including for small savings and administered rates. In its opinion, along with rebalancing liquidity conditions, the Reserve Bank should endeavor to put the resolution of banks' stress assets on a firm footing and create congenial conditions for bank credit to revive and flow to productive sectors of the economy. I'll touch on a couple of other issues first before I request the other deputy governors to speak. Regarding the guidance on liquidity, we have provided greater clarity on how we see liquidity conditions evolving and the manner in which we propose to manage them, with ongoing refinements of the LAF as recommended by the expert committee to revise and strengthen the monetary policy framework. The objective is to more finely align the operating target, the weighted average call rate, and money markets with the stance of monetary policy. You may recall that post-demonetization, there was a surge of liquidity in the system, which the RBI had to absorb to preserve financial stability and ensure unclogged channels of monetary transmission. At its peak, liquidity absorption was close to 8 trillion rupees. The RBI employed a mix of conventional and unconventional instruments. The first line of defense were variable reverse rate repos of varying tenors. The incremental CRR functioned as a placeholder till the enhancement of the ceiling on securities under the market stabilization scheme to rupees 6 trillion by the government. This enabled the withdrawal of the incremental CRR within a fortnight of its institution. From the latter half of February, the situation was well under control, greatly facilitated by the wartime pace of remonetization. This allowed A, progressive removal of withdrawal restrictions to completely lift off by mid-March, and B, increasing use of our own instruments by vacating the use of MSS securities. By the end of March, liquidity absorption was down to rupees 3.1 trillion, all of which was held in reverse repos. Looking ahead, and there are details in Part B, our endeavor will be to 1, drain out the remaining liquidity overhang, manage the new drivers of liquidity in 2017-18, and 3, ensure that the normal requirements of liquidity consistent with the needs of a growing economy are met. The first step, though not necessarily in chronological order, is the narrowing of the corridor to plus and minus 25 basis points. This is a continuation of the reform initiated in April 2016, when we narrowed the corridor to plus minus 50 basis points in consonance with the recommendations of the expert committee. The objective is to more finely align the money market rates with the policy rate, bring down volatility, and create conditions for improved transmission of monetary policy across the whole spectrum of interest rates. A collateral benefit that market participants should note is that when liquidity conditions flip to a tighter mode, the cost of funds through the marginal standing facility will be lower by 25 basis points. The second step is the assignment of appropriate instruments to the sources of liquidity. Over the first half of the year, we expect government spending to increase significantly, including due to large redemptions. Mismatches between the government's cash flows, balances, and recourse to bridge funding, ways and means overdrafts, will be managed by the use of cash management bills as envisaged under the arrangement with the government put in place in 2009. Liquidity associated with forex flows will be managed with securities under the MSS, although the budgetary provision of capping them to gross issuances of rupees 1 lakh crore will be an operational constraint that circumscribes the effective use of the MSS as an instrument of liquidity management and increases the burden on the RBI's own instrument mix, but we will endeavor to manage. Durable and semi-durable liquidity will be managed with a combination of longer tenor reverse repos and open market operations. Fine-tuning operations will continue to be used to manage day-to-day mismatches in liquidity demand and supply. We will continue to provide assured liquidity through our regular operations under the LAF. The learning experience through the demonetization period and the constraints circumscribing instruments such as the MSS underscores the priority warranted for strengthening the instrument toolkit of the RBI. It is in this context that the RBI has proposed the institution of the standing deposit facility, drawing upon international best practices and the recommendation of the expert committee. We have been engaging with the government on this subject for some time and will continue to pursue the matter with them. When the deposit facility is instituted, market participants have agreed that it will significantly improve the robustness of the liquidity management framework of the RBI. I will now turn to the issues regarding banks. An important, perhaps the most important prerequisite for efficient transmission of monetary policy is a well-capitalized banking sector that is able and willing to provide credit at reasonable terms to productive parts of the economy. The capital can come from either the market or the principal owner for the PSBs, which is the government. Having completed the asset quality review of our banks and with several other critical ingredients in place, with the Insolvency and Bankruptcy Code and the Oversight Committee, the Reserve Bank of India has been preparing actively for the next steps in an orderly resolution of bank stressed assets. This will be undertaken concomitantly with the resolution of the weakest bank balance sheets under the aegis of a revised Prompt Corrective Action Framework, PCA, and our new enforcement department that has started its work this week. We reiterate that further creeping forbearance in the treatment of bank losses is untenable and costly for the rest of the economy. The measures that will be announced soon to deal with bank stressed assets and weak balance sheets, along with the institutional strengthening that we just alluded to, should help engender confidence in our banking system, restore corporate demand, and put us on the virtuous path of healthy bank credit and industrial growth. Thank you. I'll now request Deputy Governor Viral Acharya to say a few things.
Just a few quick remarks on the management of surplus liquidity. I want to stress that with the rapid pace of remonetization and increase in the currency in circulation as we've been seeing, we do expect the quantum of durable surplus liquidity to come down over the next few quarters. However, in the meantime, so over the next several quarters, perhaps 3 to 4 quarters, we do need to manage the quantum of the liquidity that remains. And as the governor alluded to, we will employ the whole toolkit that we have at our disposal within whatever constraints we face. In particular, the MSS, longer tenor variable reverse repos, variable rate reverse repos, open market operations if necessary, however, in a well telegraphed and nimble manner so as not to have a large price impact on the GSECs. And in addition, we will keep dealing with short-term liquidity needs through overnight and shorter tenor repo and variable repo and reverse repo operations. We are awaiting a decision on our preferred facility, which is the standing deposit facility. Beyond that, we may deploy other tools if our toolkit remains constrained and contingencies that arise so demand. Thank you.
I'll little bit elaborate on what Governor has already mentioned about the issue of asset quality. We have yet to get the final results of the Q4, which has just ended. But based on the figures which were available for December quarter, the various indicators of the stress assets, they have further deteriorated during this period, though there had been some positive signals in the sense that the pace of acceleration of new NPS, formation of new NPA had relatively, it had come down. The provision coverage ratio had more or remained stable. So resultantly, the cost of credit in Q3 had come down. The overall capital adequacy of the particularly public sector banks in Q3 was above the meeting the, I mean to say, regulatory requirement, but quite clearly there would be more demand on the bank's capital as we have completed the Q4 and going forward, and also the capital would be needed for supporting the growth. So having taken stock of all this, there had been an actively engagement by the RBI as well as with the government of India, and all the tools which are required, all the options would be open and they would be employed. I think there is a clear acknowledgement and recognition that the asset quality situation in which we are, there is no one size which fits all. There would be case-specific instrument which would be required to be deployed, and a number of them were introduced by the RBI from time to time. So how to bring the faster implementation of JLF decision, how to enhance the number or role of oversight committees, or whether to look at the sectoral or size-specific approaches in achieving this resolution. These are all the options which are being considered and which are under active discussion. Thank you. PCA already Governor has mentioned. We expect to put the revised PCA framework by mid-April, and then it will become operative. There is another mention in Part B, which is of course away from the usual question which always remain in your mind, but as you know that RBI also does a lot of developmental work. So in the area of financial literacy, you will find that a pilot project is being launched, and post pilot, I think there is an ambitious project of nationwide financial literacy campaign to be carried forward. Thank you.
Thank you. Good afternoon. Among the measures that we announced in Part B, I want to highlight a couple of them. One, of course, the decision to allow banks to invest and participate in rates and InvITs within the 20% limit allowed for equity and equity type instruments that they are allowed in 20% of the capital. But I think the more important announcement that we're making is with regard to the branch authorization scheme, where we are moving away from emphasis on a brick and mortar branch to a fixed location where service is available, banking service is available, and the idea is that this will enable banks to provide cost-efficient service at where possibly cost efficiency is more important to facilitate financial inclusion, and we believe that this is going to result in further proper propping up of the financial inclusion measures by the banking industry in general, and this might even facilitate, for example, the small finance banks which have come on the scene to do their job even better. Thank you.
I'll refer to just one most important development that has been, a reference has been made to that in the policy. This is relating to the payment and settlement system, relating to NEFT actually. And this is consistent with the vision document that we have announced, Payment System Vision Document 2018. And this is the introduction of the additional settlement batches in the NEFT system. As you know, presently it is on hourly basis, and the batches start from 8 a.m. in the morning till the 7 p.m. in the afternoon, while the window of time will remain the same. Now we will brought down the periodicity from 1 hourly interval to half hourly interval. So consequently 11 more batches will be introduced, which will significantly improve the customer service and increase the efficiency of the NEFT system. Thank you, sir.
We'll take a few questions. May I request Mint?
Thank you, Governor. Basically, the first question is: do you see any sort of impact coming from this excess liquidity on inflation going forward? And with respect to NPA, what is the total extent of SDR cases which have not reached any sort of
One question
resolution?
at a time, please. So we'll just take the inflation one first.
I think the important thing to keep in mind is that while there is surplus liquidity in the system, it is actually getting drained out through the large quantum of variable rate reverse repos that we are doing. So as of now, we don't have a reason to believe that there is sort of leakage happening through that into the inflation numbers that we expect. I think the main symptom that we are seeing is the softness of money market rates at the short end. Other than the weighted average call rate, if you look at the CBLO rate, in some case, sometimes market repo, treasury bill rates, these are softer and they've been at the lower end of the LAF corridor. And a part of the intention of the narrowing of the corridor is to anchor these rates closer to our target policy rate. And as Governor explained, of course, this means that even when we are in a tight liquidity situation, the upper end of the corridor would now be lower at 25 basis points above the policy rate.
I wanted to ask Governor, what do you think are the implications of the farm loan waiver schemes, and is it a cause of concern for the RBI?
You know, there are several conceptual issues if one were to put one's hat as an economist on. I think it undermines an honest credit culture. It impacts credit discipline. It blunts incentives for future borrowers to repay. In other words, waivers engender moral hazard. It also entails, at the end of the day, transfer from taxpayers to borrowers. If, on account of this, overall government borrowing goes up, yields on government bonds also are impacted. Thereafter, it can also lead to the crowding out of private borrowers, as higher government borrowing can lead to an increasing cost of borrowing for others. I think we need to create a consensus such that loan waiver promises are eschewed. Otherwise, sub-sovereign fiscal challenges in this context could eventually affect the national balance sheet. Thank you. Economic Times?
So, Governor, you mentioned about that you can't, so the forbearance is no more tenable, and the MPCs for resolving this bad loans issue. What are the specific things that the RBI proposes to do to clean up this banking system, bad loans?
I think there are a variety of things that have been put into place, and more will be put into place going forward. As Mr. Mundra mentioned, and as has been enunciated in Part B of the policy, that a revised PCA framework is now, it will be put in public domain mid-April, which will trigger actions by the RBI vis-a-vis specific banks going forward. The IBC is now in place. The RBI's enforcement department has started its work. And the fact of the matter is that there seems to be a renewed commitment from all sides, including the government, that we now need to address this in even a more forceful manner than we have in the past. Mr. Mundra, do you want to add anything? Or?
I think I did mention in my opening statement, but one thing is very clear, a number of instruments which were already introduced, if there is a need, there could be relook even at the existing instrument, but the message which we are trying to give is that all these instruments are meant for resolution in a serious sense and not for postponement of a problem. And I think that would be the basic focus going forward.
Good afternoon, sir. Just on the inflation target side, so, the statement says that we'll try and move towards 4% in a durable and calibrated manner. This year, we are saying 4.5% first half, 5% next year, the second half. And in the monetary policy report, there are some staff projections for the following fiscal where we are saying we could come to around 4.6% by the fourth quarter of the following fiscal. Should one understand then that the RBI is comfortable with staying above that 4% mark for the next couple of years? There's no time guidance, obviously, but if the projections are suggesting that and we're maintaining a neutral stance, should we read into it to mean that we're okay with this?
So as you rightly read into the MPR and other places, what RBI is signaling is that the move to 4% is going to be challenging. There are no lucky disinflationary forces in the horizon that were there in the past. And therefore, it is in this context that they move the stance from accommodative to neutral so that there is no one-way bets on the way RBI moves. So the evolving outlook will decide how the RBI will move, but it is cautioning you that inflation is elevated relative to where we want it to be.
Pradeep Pandya.
Sir, जो फेडरल रिजर्व ने अभी ये फैसला किया है कि वो अपनी बैलेंस शीट को अनवाइंड करना चाहते हैं, इसके पहले जब क्यूई ख़त्म करने की बात हुई थी तो हमारे बाज़ार पे रुपए पे बहुत बड़ा झटका लगा था. इस वक्त आप इसको कैसे असेस कर रहे हैं और आने वाले दिनों में इसके लिए क्या तैयारी रखेंगे?
वो 2013 में एकदम सडन से झटका दिया था. ये बार 2-3 साल से बता रहे हैं, तो वी आर ऑल ग्रेजुअली प्रिपेयर्ड फॉर इट. And I think emerging markets, including us, we are in much better shape overall. And I would actually stress that on many dimensions, we are macroeconomically very stable, something that the government has taken actions towards, something that RBI has actually taken a lot of steps forward for. So, Fed is a very large balance sheet, and it does create significant capital movements in the global economy. But we are vigilant, and I think we are prepared to deal with them with the various tools we have available. Thanks.
Nikkei.
Nothing. Thank you.
Lupas. Okay. PTI. No question. Okay. Vyapar.
Sir, there's some cooperative banks have complained that whenever the administrator is appointed to conduct the affairs, they are not very open to the shareholders and depositors. Do you have any take on that? I'm talking about Kapol Bank.
See, it's not. I think it's not correct to speak about a specific bank in this context. But please understand, when an administrator is appointed by superseding the board, it means that there are problems in the bank and the administrator has a new set of responsibilities to discharge. And obviously, if the board and the shareholders were responsible enough, the need for an administrator in the first place would not have arisen. So it's not fair for the shareholders to complain against an administrator in that sense.
I'll just, I would like to just add here, as the structure of cooperative bank stands today, the shareholder and depositors are not the same thing. Basically, the shareholders are the borrowers in a cooperative bank. So too, and I think, to some extent, maybe not quoting an individual bank, but they might have reached to a present situation because of some of those actions only. So I think if administrator is working towards the safeguarding the interest of depositors, it may appear a little bit, difficult to the others.
Times of India?
Governor, Governor, the yield between the difference, the spread between the yield on long-term bonds, like 15-year bonds and home loans, has narrowed considerably. It's probably less than 100 basis points. Just want to know whether you're comfortable with this kind of narrow spread, or you expect some correction going forward.
I mean, I don't think that at this juncture we are particularly concerned about the narrowing spread. It reflects a variety of factors, including possibly slightly late transmission, so that's why it becomes evident. It could also reflect that the credit score and the credit culture in this particular sector continues to be good, and so there are no reasons at the moment why we should be concerned about the spread coming down. It's a fairly secured asset, which there is a long history of dealing with delinquency in the sector. So I think it broadly reflects market forces and the fact that housing has become an activity where there is a fair bit of government support also, which has made it affordable going forward. CNBC.
Well, to continue with what Ira asked you, Governor, you are speaking about upside risks to inflation. So should we assume that even this movement to neutral can't remain for long? That if you have to get to 4%, you will have to even go beyond neutral and get to hawkish?
The committee has also pointed out a couple of downside risks. And we have also said that the economic content of the incoming data will determine our future course. We are, of course, aware of the risks on inflation, and we have a medium-term target to achieve. So we will do that, but we feel that at this juncture, the shift from accommodative to neutral is adequate. Thank you. I think we'll end there. Okay. Thank you.